From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, April 27th. Here are the top market stories we are following for you at this hour. A tale of two titans. Microsoft beats thanks to the cloud, but Alphabet struggles with advertising headwinds. That sets the stage for Meta due after the bell. We'll have more on tech with Mark Lehman of JMP Securities. Archegos arrest. U.S. prosecutors charge Archegos Capital Management founder Bill Wang and CFO Patrick Halligan with fraud after the dramatic collapse of the family office. Federal agents arrested Wang earlier today. And flows halted. Russia cuts off gas supply to Poland and Bulgaria for refusing to pay in rubles. Four other European buyers have already paid in the currency, but Ursula von der Leyen says doing so violates sanctions. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alix Steel is off today. Welcome to Bloomberg Markets. Guy, it's Wednesday, and I have a lot of questions about a lot of different things.
Yeah, I don't have any answers. I'm really confused about the gas story. I can't figure out exactly what is going on there. We're going to speak to Thierry Breton from the European Commission in the second hour of this program, the European Close. Maybe he'll be able to provide some clarity. The tech story, I think, is really fascinating, Kaylee, in terms of what we got yesterday, particularly looking at what is happening with Alphabet, coming through with, in many ways, disappointing numbers, but a big, big buyback program. And that clearly is not enough right now. And I think that's got implications for Apple as well. So I think there's, a lot of questions floating around, not a lot of answers. We're also expecting a press conference regarding that Archegos story in the second hour. Hopefully we'll bring you the kind of the most germane bits of that live just after the European close. So all of that is coming up. We've also got some data coming out right now. Let me just bring that up on the screen to see exactly what's happening in the housing market. We have pending home sales dropping right now. A little weaker than anticipated, but the prior number actually down by minus 4.1, revised a little bit better. This number, negative 1.2. The economists were expecting negative 1, and the non-seasonally adjusted year-on-year number, negative 8.9%. So you're still getting a little bit of an effect coming through, I think, from the supply chain shortages that sector is experiencing. But actually, we're not going to focus on housing. We're going to focus on what is happening in the tech sector. As Kaylee says, some really interesting questions swirling around this sector, and we've yet to get all of the answers. Many reports still to come. But what are tech earnings telling us right now? Let's try and answer that question. Anurag Rana joining us, senior software analyst at Bloomberg Intelligence, and Jackie Davalos, Bloomberg technology reporter, who was doing some great work, I have to say, on the top lives yesterday as these numbers came out. Jackie, what was your biggest takeaway? What are we learning here from the tech sector stories we've seen thus far?
I think one of the big themes that came out of Alphabet's earnings, as well as Microsoft together, is that cloud demand is very resilient. I think there was a lot of concern about what would happen to cloud computing and its customer base if that demand will hold up in the face of returning in-person services and activities. And I think the results showed that there is still healthy demand for this, albeit a little bit less than the turbocharged growth that we saw during the pandemic, but it's still propped up both businesses.
Well, Anurag, to that point on the cloud, you were on with us yesterday previewing these results, and you essentially said the cloud is a recession-resistant business in many senses. Give us your take on what we saw yesterday on that front.
Yeah, a few things. First and foremost, these growth rates will slow down over time. It's just a function of large numbers. It's nothing more. Cloud is a very nascent market, or cloud infrastructure is a very nascent market where Google and Amazon and Microsoft largely operate. And there is a long, I would say, paths that we still have to cover for it to be mature. So, whether it grows 45% or 47 or 30, it really doesn't matter because the size is so big down the road. As far as other businesses, I think Microsoft really showed us that the critical part of the portfolio that they have, people will spend money irrespective of what the economic climate is.
What do investors want, though, Anurag? I'm looking, Microsoft's up 4, Alphabet's down 3%, we're talking about here. What do you think separates those two businesses in terms of the way that investors are reading the numbers?
I'm a little more biased towards technology companies. I didn't find anything that wrong with Google results. Frankly, from my side, I look at their numbers. They're still going to grow 15, 17% going into the next 2 years. Even if they grow 13, 14%, what's the big deal? Because in my view, I look at something like a Costco that grows at like 7, 8%, and it's trading at 40 times earnings. And people are, looking at Google and saying, oh, you're like 16, 17 times earning, and it's expensive, and we should, sell this. So it doesn't make sense to me, at least. But I'm more focused on tech companies. I think they are phenomenal businesses, far better than any other that's out there.
I have to say, I think when it comes to Google, one of the big highlights there was, this focus, investors homing in on its YouTube advertising business, and that, it's come out as a major player in search, and also the type of advertising that it has exposure to. I think we're going to start to see some of those divergences, especially as we have Meta report today.
Yeah.
YouTube ads were particularly disappointing, Kaylee. I think they were expecting much bigger growth. And what it showed is that, look, it was not at the numbers that investors were expecting, but the bigger picture is that they are focusing more on short form videos, and TikTok is a major competitor there. So they're going to have to address that weakness for those numbers to come up.
Yeah, all the cool kids apparently are on TikTok. I myself am not, but it definitely is a big factor. So talk more about the read through then to Meta after the bell today, and then Twitter as well tomorrow, or there's an argument to be made there how much those results really matter when Elon Musk is going to take the company private anyway.
Absolutely. I think when it comes to companies that have digital advertising exposure, they are more exposed to those swings of e-commerce versus, a search ad business. And so looking into Meta today, I think we're going to want to see how are Reels doing. Now that we saw how important short form videos are to Google, investors are going to want to see progress versus Reel. How's that viewership comparing to TikTok? Google's short form videos right now have 30 billion views, which was a number that I think really surprised the street. And so kind of setting a baseline, Meta's going to have to show what progress they're making on that front as well.
Anurag, let's just talk about another metric on which these companies are judged, and that's buybacks. How important is it, the size of the buyback that you deliver? Because it's almost taken as a given now, I think, that the buybacks are going to be enormous. And I'm wondering whether actually investors kind of move past it fairly quickly. And I wonder if that's going to be a problem for Apple further down the road this week.
Now, in the short term, it could be an issue. But, in our view, you look at these three companies you talked about. Apple's going to generate somewhere in the $90 to $100 billion in free cash flow this year. You look at Google, it's about 68 to 70 billion. Microsoft, north of 60 billion. What are they going to do with that cash? It's very difficult for them to buy companies. So they have to buy back a lot of their stock. And one of the things we mentioned yesterday was Apple, over the last 5 years, has reduced its share count by about 23%. Going forward, they're going to reduce their share count every year by 4 to 5%. That's a very, very big number for investors. So even if you have flat top-line growth, you're going to get EPS growth of at least 5% just on that alone, let alone any kind of operating margin expansion or any other things. And that's a very big factor in our view.
Well, talking of big factors, is that alone enough to support these stocks individually that in and of themselves are massive factors for the equity market writ large? I'm just trying to understand what tech leadership or lack thereof is going to look like more broadly.
So once again, if you are a long-term holder, you'll be happy because the stock goes down, they're going to just buy more. So, from that point, it just doesn't make that much of a difference for a long-term investors, because one of the most important thing you want to think about for any of these companies is, can somebody threaten their business models? But if you look at the top three companies that I mentioned, I'm not counting Meta and Twitter in that, but the moat that these companies have, along with Amazon, it's only grown tremendously over the last few years, and we see no barriers we see no competitor that can come out and take that away from them.
Jackie, just in terms of what we're going to be looking out for the rest of the week, what should we expect for Apple? What are we looking for here? What are the details that you're going to focus on?
I think the story here is going to be the impact of supply chain issues and those COVID-19 restrictions in China. You look at Microsoft, who was fairly resilient when it came to their PC business and those Xbox consoles. Those sales remained pretty strong, but there are more exposures to Apple when you think about our phones, our personal computers, iPads, all of that. If they want to keep sales up and meeting consumer demand, I think we're going to have to, see what kind of impact this is having. And we thought we were worse. The worst was over with COVID, but as these restrictions start to re-emerge, Apple might be one of the bigger ones that tech giants that are hit from that.
And on the subject of Apple, Anurag, we actually just had a viewer writing into us on the IB chat. Remember, you can do that on your Bloomberg terminal. His question is, why not pay special dividends instead and really help stakeholders? Why can Apple not do that?
Well, yeah, they can do that. I see no logical reason they can't. I mean, it depends on, once again, you go back to Buffett's methodology. If the stock is selling below its intrinsic value, the company should be buying back as much stock as they can, or they financially, they're able to.
All right. On that note, we will leave it. Thank you so much to Anurag Rana of Bloomberg Intelligence, as well as Bloomberg's Jackie Davalos. Now, coming up, we'll continue this conversation on tech earnings and their implications. BlackRock's head of thematic strategy for global allocation, Kate Moore, will be joining us next. This is Bloomberg. It's a big week in big tech earnings. Yesterday, we got Microsoft and Google. Later, we'll have Meta and Qualcomm. So let's get back to our question of the day. To this point, what are tech earnings telling us? Let's ask our next guest, Kate Moore, head of thematic strategy for global allocation at BlackRock. Kate, are we even getting a clear signal yet?
There's not necessarily a clear signal for the entire sector, and certainly not for the whole market. But what I will say is, and this is coming not just from tech earnings, but from commentary from companies across different industries, tech spending is much more resilient. The previous two Bloomberg contributors who were just on that segment before me, mentioned this idea that sort of tech spending is recession-proof. And we're getting that information from different companies. No one wants to cut, and no one can afford to cut, frankly, their cyber software budgets. Most people do not want to reduce their spending or decelerate their move to the cloud. And some of these companies, particularly the higher multiple software companies, either playing in the cyberspace or playing in the kind of broad cloud adoption, had really derated over the number of, it's now about 6 months worth of derating. And they're starting to look very, very interesting, I have to say, from a medium-term prospect, especially if you think the economy is going to soften over the course of the next 4 to 6 quarters.
What assumption do you have to plug into that, though, Kate, for interest rates? Bridgewater thinks that the Fed's going to have to go significantly higher in order to contain inflation, well higher, well north of where the market expects it to go.
Yeah, so, at BlackRock, we're very much in the camp that the Fed's going to move 50 basis points at this next meeting and likely follow a lot of the market pricing, perhaps another 250 basis point hikes after that. That said, I think we all know, students of monetary policy and students of economics know that monetary policy works with long and variable lags. And the Fed is not going to try and get too aggressive, particularly hike too aggressively into a softening economy. One of the big challenges that we talk about all the time, and I know you guys talk about on air all the time too, is that a lot of the inflationary pressure is frankly from the supply side. And sure, we can calm demand a little bit, but it doesn't change some of the supply disruptions we've had as a result of the pandemic or China's shutdowns, or it's not going to really change the mix in the very near term that's driven by, at the headline level, much higher energy prices as a result of Russia's invasion of Ukraine.
Well, Kate, to your point on inflationary challenges, supply side issues, all of that reads through right to corporate margins as well. Have you been surprised by what we have seen on that front thus far, 2 weeks into earnings season?
I've been really encouraged, Kaylee, I think is the way to think about it. Stepping back from this past quarter, just think about the last couple years. Their naysayers and the skeptics have been saying for not just a couple quarters, but for years, that corporate margins were set to collapse, that it was going to be impossible for companies to maintain their costs in a revenue environment that looked more modest. And now we have a pretty robust revenue environment, but now we have so many additional cost pressures. I've been really encouraged because what we're seeing is a continuation of, frankly, a behavioral shift that began 10 years ago post-GFC of corporate management teams really focusing on their bottom line, controlling costs, upweighting businesses that have higher profitability and higher chance of maintaining margins, and really streamlining wherever they can in order to maintain their margin story. So I do think that margins are unlikely to expand in 2022. Stabilization or modest degradation seems like a giant win, but I am certainly not in the camp of the margin collapse, run for the hills.
What is your view on volatility right now, Kate? We've got a situation where it's elevated, it's not that elevated. VIX is kind of circa 30 right now. Should investors wait for a lower volatility environment? Are we going to get a lower volatility environment? These markets seem pretty confused right now. We're being whipsawed on an almost daily basis.
Yeah, the markets are confused, and the uncertainty factor, guys, is some of the highest we've seen in the course of the last number of years. I would argue for most of us, in my 20-something year investing career, this is the most confusing it has been. And that uncertainty factor is, as we know, driven by a multitude of different forces. It's not just the path of policy rates and the path of inflation, the ending of the pandemic. Hopefully, we have a conflict in Ukraine. We have spikes in energy prices, really weak consumer sentiment, which I think is driven more by politics than actual policy or the economy. There's just so many cross currents, and against that backdrop, it's really hard to see vol coming down dramatically. That said, in the fund that I work on, global allocation, we take advantage of higher vol environments and have been employing tons of option strategies across our book in order to really capitalize on this higher vol.
But on the subject of volatility, uncertainty, and asset allocation, we ask often, in this kind of environment when none of us seem to have a real clue what is going on, is this an environment you want to be in cash? Usually the answer is still no, but you actually think there's a role to play here for dry powder. Why?
Absolutely. So we are a multi-asset fund, and we can kind of go anywhere in the world. We're holding very high cash levels relative to our own history. Some of that cash is actually an expression of our duration view, because we do think rates will move higher from here as the Fed adjusts policy rates as inflation is stickier. Some of it is also that we've de-risked parts of our equity book in response to this high uncertainty factor. By the way, when we've de-risked, we've raised cash a little bit on the equity side. That doesn't mean we've hidden off in defensives or in kind of lower quality companies. We still like a lot of high quality growth companies that can, we think, perform well once we get through this sort of sentiment bubble. But yeah, we're holding really high cash relative to history. I think it's an important asset class right now. And we want to have dry powder for the future, but we also want to protect the returns we've had thus far this year.
Kate, what kind of catalyst would you be looking for to deploy some of that dry powder?
Yeah, it's a great question. And I have to be honest, it's something I ask myself every day. What is the positive catalyst that could really get me to start taking a lot more risk? What I would say is a small positive catalyst, frankly, is the amount of negative sentiment in the equity market at this moment. We've seen institutional investors, certainly on the hedge fund side, also on the real money, and retail investors all become quite cautious around risk taking. That can be a contrarian indicator, but that is not sufficient to take a lot more risk. I think we need confirmation that there is no real degradation in particularly the U.S. economic story. There's a lot of talk, as we know, about recession and recession risk coming sooner rather than later. If we get more high-frequency data that suggests that the U.S. economy is good through the course of 2022, I think that will be supportive, combined with very bearish positioning and sentiment. I think that could be supportive. But a big rip higher to, kind of flat for the year or to new all-time highs is not in my forecast for the next couple months.
Kate, it's always great to catch up. Thank you very much indeed. Kate Moore of BlackRock. Greatly appreciated. Okay, what do we got coming up for you? The latest fallout from the collapse of the Archegos capital scandal. Founder Bill Huang and his CFO have this morning been charged with fraud. Huang has been arrested. Details next. This is Bloomberg.
It was a spectacular collapse of a family office, one that cost banks and investors billions of dollars. Now, federal authorities have charged Archegos Capital Management's Bill Huang and his CFO, Patrick Halligan, with fraud. With us now is Bloomberg's Wall Street correspondent, Sonali Basak. She literally has the entire indictment guide printed out, and it looks like a small manuscript. Understand 11 criminal counts. Can you just walk us through what exactly these charges are, Sonali?
This is required reading for bank general counsels and lawyers across Wall Street. You know, this is really outlining exactly what happened, how he amassed up to 50% of the outstanding float of some of these securities, things like GSX, Viacom. He had an enormous amount of what was daily traded. So how did the banks then not know? They said the banks were misled in some of the language that the SDNY laid out here. As we know, we'll hear more from a press conference a little later from the Southern District. But there's also some more detail here. Working with another hedge fund, for example, in some of the stock trading that happened in the background here, the way that the Archegos fund had traded stocks pre-market into the close and post-market in order to inflate some of the values of these stocks, and really how the entire scheme had come together. Now, the question that remains is how will Bill Hwang and his team respond, and what is left for the banks to say after they've already incurred these losses and regulators are already conducting their investigations on their own.
Absolutely. But Sonali, is this an opportunity for the banks, or is this a risk for the banks? There are lots of red flags around Bill Hwang already before we had this scandal blow up. And is there a danger that they end up looking even worse as a result of the details that are likely to flow from this investigation, from this prosecution?
Yeah, I think that's the big question. There's one meeting that people keep on talking about that happened in the wake of some of these price movements, and the banks had all gotten together and really had a conversation about what they do with these positions. The big question that remains is, should they have called the regulators in that event? Why did they try to handle this on their own? As we know, the banks sold the stocks on their own right, really got out of these positions early on. Some of them were able to mitigate losses, and some had much bigger losses. The banks are fighting among each other, as we know, with some of these moves that happened early on in Archegos. So what we do know, and you and I have talked about this, Guy, that regulators have already both been investigating. You have the DOJ, you have the SEC and others really looking at what happened here and if there's anything wrong that the banks had done. But then also the fact that should there have been more regulation in place? Now we are waiting for a new Fed supervisory chair, and will they go back and say that the banks should have a better handle on how much leverage their clients are amassing, and can they amass these positions on swaps in such a large way?
Yep, lots of unanswered questions. Maybe we'll get some answers. You never know. Sonali, thank you very much indeed. Press conference coming up. We'll bring the details of that press conference to you live. This is Bloomberg.
We are an hour into the U.S. trading session, and equities are struggling for direction. The S&P 500 was clinging to a gain. Now it's essentially flat, and while the Nasdaq 100 was higher earlier, it's now down by about 0.25%. The market really trying to digest big tech results. I'll have more on that in just a second. In other asset classes, though, you do have a 10-year yield that is moving higher, so a little bit of selling pressure in the bond market. We're up about 4 basis points, 275 or so is where we trade. What's really interesting is the dollar. The DXY out at a 103 handle. That is the strongest U.S. dollar going all the way back 5 years. And of course, a large part of that actually has to do with euro weakness today. And that relates right back to a gas story that, Guy, I don't think either of us really can figure out. First, you had Russia cutting off flows to Poland, Bulgaria, because they refused to pay in rubles. Then we got news that some companies are paying in rubles. Then Ursula von der Leyen comes in and says doing so actually violates sanctions. A lot of question marks for Europe more broadly, but especially the natural gas market. Dutch front month futures up about 18% over the last 2 days. To come back, though, to that earnings story I mentioned, of course, you have some big decliners off of the back of earnings. Boeing is one of them. Worst decline for this stock potentially since 2020, down about 12% after misses across the board and a way larger cash burn than analysts anticipated. And then a mixed story when it comes to those tech titans. Microsoft benefiting from strong growth in the cloud. It's up more than 4%, while Alphabet is down more than 4% due to advertising headwinds. The question now, Guy, how does what we saw with Google and YouTube especially read through to other advertising-reliant companies like Meta? It reports after the bell today. It's down about 3% ahead of that, Guy.
And how does the really strong performance in the cloud of Microsoft relate to Amazon? AWS potentially is going to have a good story off this to tell. We'll see. Obviously, as we work our way through this week, we're working towards Amazon. Sorry, not Amazon. Apple a little later on this week as well. Busy week. Lots of things to get
Absolutely.
through. A lot of them seem to begin with A. Okay, more on tech earnings now. Mark Lehman, JMP Securities CEO, joining us now. It's a Citizens company. It specializes in investing in tech. Perfect man to talk to. Mark, what do you make of the situation thus far? What did we learn last night?
Well, we learned that there's not a lot of clarity. And I think we had expected more clarity when we got some of the tech titans to report. And Microsoft obviously continues their ascent. And the advertising market and the competition, like Netflix has shown us, and now YouTube has shown us in that space, is heightened. And that when you have heightened competition, margins start to go down. And that's what we're seeing for some of those names.
So for the ones that have yet to report, what would you anticipate? Let's just start with what's reporting today, Mark. Meta, what's your expectation?
I mean, Meta has already had the tough fourth quarter that we saw reported earlier this year. I think expectations are a lot lower. That stock continues to make new lows, new 52-week lows. I think any inkling that some of the bleeding has stopped for them, and the stock should react more positively. But competition is not slowing down. TikTok usage continues to accelerate, and some of the things that are happening to Facebook on all their sides, their expense bloat, continues. I think the slightest whiff that they have this under control, the stock will do better because it has had such a huge decline this year. But that's what I expect today. And we'll see those numbers. If they have any clarity that the declines have slowed, I think the stock does better.
Mark, why do I want to own any of these stocks? Is it because they're growth stocks? Are they still growth stocks? Or are they basically buyback stocks? They are juggernauts in terms of the amount of cash that they are producing, certainly the big ones like Microsoft and Alphabet, and they're buying back stock and they're buying it back aggressively. What is the central case for wanting to get involved here and put money to work here?
Well, it's a great question. I think when we went into 2020 and 21, we kept talking acronyms. We talked about the FANG stocks, and we talked about, I called it Mount FANG because I added Microsoft and Tesla. And you just wanted to buy all those stocks. And now we're learning that they're not one big monolith, that you look at a Microsoft reporting versus what we saw when Netflix reported, and they're wildly different stocks. So that's the first thing. The second thing is they're getting to reasonable valuations. You look at where Alphabet's trading today, and you look at the kind of EPS power that they have while they're making some investments, and the earnings power is still substantial. And they're going to have a 5% free cash flow yield next year. 5% for a company that's growing that fast is pretty attractive. Right now, nothing's attractive. And I think it's very easy to sell and say, I'll get in later. Well, we all know getting in later is hard to do because there's always a time. No one, the light switch doesn't dim when things are bad. It crashes to off, and you got to figure out when to get back in. And I think that's what investors have to figure out. A company like Alphabet with a 5% potential free cash flow yield next year is wildly attractive. Maybe not today, maybe not tomorrow, but eventually.
But what are you assuming rates are going to look like with your assumption then that Apple's going to look that attractive? I mean, what level are we talking on the 10-year mark? On real yields, especially.
That's the real, and I think that's a good question. I think there are some signs that some of the pressures on inflation have abated, right? We saw used car pricing last week. We saw the consumers definitely trading things that they can do with their money as opposed to doing everything, right? They're doing experiences. We see travel picking up. We see some other things that are slowing down. And I think that inflationary pressure, when we see that it starts to abate and some of the numbers going into the fall, I think you're going to probably see the 10-year settle in about where it is today, if not slightly lower. And that'll be a great backdrop for companies like Alphabet if you'd like that 5% free cash flow yield. But there's right now, boy, when earlier in the show you said the VIX is kind of settling in there at 30. As a person who's been on Wall Street for 30 years, that don't sound like settling in there. That sounds like more volatility is in front of us, and nobody cares.
How low? What would be an entry point for you on Alphabet?
Well, I think today's an interesting example. You got a stock that's down a great deal from its all-time high. Although let's not use that as a moniker because we have lots of stocks that are down a lot from their all-time high, and that doesn't mean you want to buy them. But a company like Alphabet that is gaining market share, that has platforms that are growing rapidly, that's in every growth sector of what is going on in our economy today and going forward, you can own one of the great platforms at a 25 or 30% off sale. That's a good entry point. I wouldn't tell you that today is the day that you got to put all your capital to work. But I think over time, if you got into the stock over the next 6 to 12 months, as they continue to heighten their market share, and it gets more and more attractive as we're looking more and more at 2023 earnings as opposed to 2022, you'll want to be a participant in that stock. It's very hard on days like today and weeks like this week to feel a lot of conviction. That's why the VIX is at 30. But over time, I think that's where you want to be.
All right, on the subject of market share, obviously the dominant market share player in the cloud at this point is still AWS. It's still Amazon. Can you just walk us through your thesis around that business and that company in particular?
I mean, Amazon is like you said, is everybody knows and everybody uses it every day. So they understand what the consumer business looks like. But I think they're high growth businesses like Microsoft's high growth businesses in the cloud. And I think that share and that move has not even close to being a mature business. And I think that's another stock. Amazon's had a tough year, like a lot of the consumer facing stocks, but their share in the cloud is growing and their margins in that space are growing. And I think there's a lot of digestion in some of these big growth tech growth stocks like Amazon. And you saw what Microsoft did. Despite fears of a slowdown, what they did in the cloud was so substantial this quarter that has the stock higher today. Another example of a company where I think you're going to look at a year from now and say, I had an opportunity to get into the stock at a more attractive valuation at a time when there was lots of things to worry about. And there's worries about the consumer. There's worried about some of the growth businesses Amazon has, but the cloud business is not one I worry about.
How do you think about Apple? As we look towards the numbers later this week, what is Apple? And that leads me on to kind of what should we look for in the numbers? This is a company that is increasingly migrating away from being a hardware company, but it is still predominantly a hardware company. Is the market getting to the point now where it can understand the services business? And how do I fold, for instance, what has just happened with Netflix into that narrative as well? I'm just trying to think about how you value Apple as a services business and how that is different to Apple as a hardware business.
Well, it's a great question, and I think that answer we'll know in a bit. But I think you phrase it properly. Continually, the numbers are migrating to more of a service multiple and more of a service company. It's ubiquitous, right? I mean, you looked at some of these pronouncements over the last quarter. I read one with kind of a little bit of a smile when they said that getting a green text is not viewed on college campuses and around the world as a good thing. We want blue text, meaning we want Apple text, which I think tells you about the power of that company. They're also pretty quiet, which I think is really interesting. Tim Cook is one of the quietest CEOs. And I don't mean that he's not powerful. I mean, when you look at people like Elon Musk and some of the other people who are on the cover of all the newspapers and all the shows every day, we haven't seen Tim Cook a lot. Yet you look at the power of what he's done in the last year, about what he's done, frankly, to some of the market caps of some of the big tech giants, and you realize how powerful that company is. And they've quietly gotten more and more into a services company. They've quietly disrupted more of technology than everybody else.
Yeah.
So whether we're talking about payments or mobile or auto or entertainment or all the things that they have, healthcare, it's growing rapidly right underneath the veil of all these loud CEOs who are telling you how great they are. Tim Cook just executes. And I think that's
and Mark,
a fascinating point. Yes, please.
That execution has also gotten Apple a very, very nice pile of cash. And we were speaking with our Bloomberg intelligence analyst, Anurag Rana, about this earlier. You have all of this cash. These companies, because of regulatory risk, can't really use that to buy other companies. So where else are you going to put it other than buybacks? Is that the best use of cash? And do you expect that to be really the only place that these companies can start to channel some of the money that they're generating?
Well, that's a great point. And I'd push back on one point, which is the specter of regulation has been far more worrisome for these companies than actual regulation. And the specter of congressional oversight has been far worse than the actual oversight by Congress. We saw Mark Zuckerberg put his suit on, which he does once a year to talk to Congress and defend himself. And we haven't seen him put a suit on in a while. He hasn't been in front of Congress in a long time. They're busy with COVID and the war and the election. They're not busy with oversight of these companies. Microsoft's made some acquisitions, as you know, in gaming and cyber and some other areas. I would not expect the acquisition binge to slow down. They may be smaller, although Activision was quite a big acquisition. They may be smaller, but I don't expect these acquisitions to slow down. I think they have a real playbook about where they see these multi-trillion-dollar markets, again, whether it's healthcare or automotive or entertainment or cyber or all these places, and they have their playbook, and they're going to keep going until they're told to stop. And I don't see them being told to stop.
All right, on that note, we will leave it. Mark Lehman, CEO at JMP Securities, a Citizens company. Thank you so very much for joining us. Now, as we were having that conversation with Mark, we have to as well pay attention to the evolving situation when it comes to Russian fossil fuels. We had a headline crossing from Germany. They say they are ready to support an EU ban on Russian oil if it is gradual. So again, this is oil. This is not gas, which is really the question for Europe at the moment after we saw the cutoff of gas flows to Poland and Bulgaria. But again, Germany ready to support a ban on Russian oil if it is gradual. I think the timing here is probably going to be key in this one. Guy, of course, we had JP Morgan making that call last week, $185 oil if you were to see Europe just cut it off, cold stop immediately. Gradual, though, is a bit of a different story because you have room to get that oil to other places in the market like India and China.
Yeah, oil is a little bit more fungible, a little bit more transportable than gas is. The gas pipelines go in one direction, and that's towards Europe largely. So that's a much more difficult narrative. Germany can sort of uses around 40%, gets 40% of its gas from Russia. The oil story, I just wonder whether this is a bit of distraction coming through here. I appreciate that the oil usage story is a significant one, but the issue is gas.
Yeah.
That's where the focus of attention is right now. And the rules for European companies, I don't understand them. You and I have joked throughout this entire program. There is this two-step process. You can transfer money to Russia in euros. Those euros are then converted into rubles. That keeps the Kremlin happy and largely seems to circumnavigate the sanctions rules. But von der Leyen's indicating that's not the case. And if von der Leyen's indicating that's not the case, then in theory, Germany should stop using Russian gas.
Right.
It can't pay for it. I don't know where we are on this. And I think we really need some clarity, and we need some clarity soon, because Germany is going to potentially be facing a significant recession if that is cut off.
Yeah, we will continue to look for clarity and try to get answers to our questions. Meantime, Guy, Boeing executives are answering questions right now as the earnings call is underway after that really brutal report. Shares down more than 11% as a result. We'll have those details next. This is Bloomberg.
This is Bloomberg Markets. I'm Angel Feliciano, live in the principal room. Sherry Paul, Morgan Stanley Private Wealth Senior Portfolio Manager, joins Bloomberg TV at 3:30 p.m. in New York. This is Bloomberg. Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. The European Union calls it blackmail. Gas prices on the continent surged more than 20% after Russia stopped natural gas flows to Poland and Bulgaria. Moscow made good on a threat to cut off buyers if they didn't pay in rubles. Bloomberg's learned that some European companies have already paid rubles for gas. SpaceX has launched 4 astronauts to the International Space Station. It's the first NASA crew equally made up of men and women. It includes the first black woman making a long-term space flight, Jessica Watkins. They'll arrive at the space station 16 hours after launch. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Kaylee.
Angel, thank you. Meanwhile, shares of Boeing are lower, substantially lower. The stock off about 11% at this point. It ran into first quarter headwinds from inflation, the war in Ukraine, and the lingering effects of those 737 MAX crashes. The analyst call is underway right now, and with us is Brooke Sutherland of Bloomberg Opinion. She has been following the call. She is also with us. Brooke, this is really quite ugly.
It is, and I think what's striking about it is that this is far from the first ugly quarter that we've seen out of Boeing. I mean, it's now been 3 years since the second 737 MAX crash, and obviously the effects of the pandemic were significant on Boeing, but we're still just getting these self-inflicted wounds, if you want to call it that. I mean, about $1 billion in charges announced today in the defense side of the business, having to do with some of these fixed cost programs. Their strategy there a few years ago was to bid low on the expectation that their commercial aerospace program would give them more cover to be competitive. And obviously it has not played out as expected. But the fact that we're still getting these kinds of updates, I think is just very difficult for investors to wrap your mind around. What is the strategy? Where is the exit ramp? How do we get back to a point where Boeing is, an investable stock again?
DC Dave Calhoun joined 2020. It's not been good since then, Brooke. How long has he got?
Yes, I mean, with Calhoun, I think obviously it has not been a success. I think it would be a stretch to call it that. I mean, I have a hard time pointing all of the blame toward him, just because I think he obviously inherited a very difficult situation. I mean, a lot of what we're talking about are sort of consequences from bad decisions that Boeing made a very long time ago. And, the thing with aerospace programs is that these consequences take a while to catch up with the companies that are involved. And I think, what's difficult is I don't know if anybody could have navigated Boeing through these troubled waters over the past couple of years. But I just think it's very difficult to look at these continued delays on their aerospace programs, some of which are out of their control, some of which are not. And to see, again, where do we get back to a point where Boeing is consistently generating strong cash flow?
So how are Calhoun and the other executives defending themselves on the call? You were listening to it. What are some of the key takeaways from that?
They're still positive on being cash flow positive this year. I mean, I think that's difficult to see how you get there. You do have to hope that maybe some of these 737 MAX deliveries might start picking up again. Right now, that is complicated by the fact that they're not delivering them to China. There was, of course, that crash on an older 737 model, which sort of complicated the picture there for Boeing. And then also, perhaps more significantly, you have the lockdowns in China that are limiting demand for air travel. So if you're an airline in China right now, why do you want more airplanes? And so, again, a lot of this is out of their control, but that's not a great sales pitch right now. And look, certainly they're not the only company dealing with inflation, the effects of the war in Ukraine, supply chain constraints. We heard yesterday from GE, 3M, Raytheon. They are all dealing with these issues too. I think what's different in the case of Boeing is that it has so many idiosyncratic problems. So if you're looking for a place right now to invest, to bet on the industrial economy, it's tough. And aerospace, ironically, should be one of the bright spots. I mean, we've heard from all the airlines that business travel is starting to come back. International demand is picking up. People are getting back out there. Airlines want to buy new planes, but Boeing just can't get out of its own way.
They make the F-15, the F-18, they make the Osprey, they make the Apache, they make the Chinook. Brooke, there's a big war happening. How is a company with a major defense footprint not in a better position right now?
Well, I think one of the things that's interesting is that, we did see this big rally in defense stocks on the war in Ukraine, but it does take some time for those dollars, that spending that we've been talking about coming out of greater defense budgets in Europe to hit those companies' income statements. So that is a later story, probably more like 2023, 2024, where we really start to see the impact of that spending for these companies. And in the case of Boeing, I just come back to, they underbid on some of these programs to be competitive, to make sure that they won them. And then now they're paying the cost for that, because these are fixed cost programs. When you have inflation, when you have supply chain constraints, that makes that calculus tougher.
A lot tougher. Brooke, great stuff. Thank you very much indeed, as ever, for the analysis. Brooke Sutherland, the Bloomberg Opinion. Greatly appreciated. This is Bloomberg. About 34 minutes to the European close. Let's talk about the price action on this side of the Atlantic. European stocks bid. That's not where the story is. The story's in euro dollar. Look at this. 105.22. We're about to break 105 by the looks of things. That's certainly the direction of travel. We're down by around 1%. And it comes down to this problem here, the nat gas story. We've seen the start of Russia beginning to cut off Europe from gas supplies. There's confusion as to how you can pay for gas supplies. Apparently, if you pay in rubles, you're in breach of sanctions. Apparently, that leaves 4 countries potentially 10 companies in breach of sanctions. Does the two-step process where you pay in euros or dollars and they get converted into rubles, is that acceptable? Well, we're going to hopefully find out in the next hour. We're going to be speaking to the EU's Internal Market Commissioner, Thierry Breton. He's going to be joining us from Brussels. It's an exclusive interview coming up. We need some clarity on this. Von der Leyen saying basically you're in breach of sanctions if you're paying Russia. Is that actually the reality of the situation? And if so, how big a problem is that for Germany? The close is next. This is Bloomberg.